Hi everyone, Matt Connor here with Connor Management Group, and this week we're here to talk about the best TV broadcasting stock to buy right now. Today is Thursday, May 8th, 2014, and here on the opening slide we see that the 12-month upside potential of this name is quite significant. We see its upside potential at 120% over the next 12 months. Now, some of the stocks that are in the TV broadcasting space, just to give you a feel for the kind of companies we're talking about, are companies by the name of Albitron Communications, Belo Corporation, CBS Corporation, Granite Broadcasting, Hearst, Ion Media, Liberty Media Corporation, and Sinclair Broadcasting Group. So those are some names that you may be familiar with in the space. And on to the next slide, we see that the name of the company we're talking about is called Intravision Communications. Intravision Communications, their ticker symbol is EVC. The industry, TV broadcasting, and yes, we see the 12-month upside potential at 120.0%. On to the next slide, we have some quick facts about Intravision. Intravision Communications Corporation, together with its subsidiaries, operates a Spanish language media company that utilizes a combination of television and radio operations to reach Hispanic consumers primarily in the Southwest and Southeast United States and the border markets of Mexico. The company owns 56 TV stations in 24 markets. They're all Univision affiliated, and they also own 49 radio stations. That's 38 FM, 11 AM stations in 17 markets, and television accounts for 70% of their revenue. So this is a TV broadcaster that has a significant market presence, and we'll get into tell you more about it, why we think it's a good buy right now. So the website for Intravision is intravision.com. That's www.entravision.com. The company is headquartered in Santa Monica, California. They were founded in 1996, and the number of employees they have is 962. So that alone kind of lets you know that we're looking at a much smaller company than we've looked at in the past, but they have a pretty interesting story. Once again, the ticker symbol is EVC. The sector they operate in is services, and the industry is TV broadcasting. The annual revenue over the last 12 months was $224 million. Their net income was $132 million. Their cash from operations was $33 million. And their market capitalization was $443 million. On to the next slide. We see on the products and services slide, there's not too much to show. There's Intravision with their logo. There are pictures emphasizing their presence in television, another one in radio, and two more implying that they have an online and mobile presence. There's also at the bottom a list of logos of some of their media properties, some of which are affiliated with Fox television, as well as the CW network, and a host of others. So this company is much smaller than a lot of the companies we've looked at in the past. I think this is the smallest company we've looked at with a market cap well under $1 billion. But Intravision, I mean, as mentioned, they have 56 television stations, and they have about 49 radio stations. Now, overall, I mean, this is a low price stock. I mean, right now they're just a little bit over $5, as we'll get into. But there are a number of good things on the horizon for them, which is why we think this is an interesting buy right now. The price, as you'll see, the price had been as high as in the $7 range, and it's pulled back a bit to the now $5 range. And the reason for that pullback was related to some regulatory uncertainty from the FCC regarding how some television and radio stations can earn revenues related to marketing for other affiliate stations. Basically, those are a ruling that had a lot of people investing in the television and radio station quite worried. And essentially, the FCC ruling limits the amount of revenues that one radio television property can receive from marketing for other properties in the same market. It's basically kind of trying to think of the right words, trying to limit the monopoly power of certain radio and television groups within the same market. So essentially, that ruling of limiting the amount of those affiliate revenues it can collect is not expected to affect Intravision much at all. So as a result of that ruling, a lot of concerns have been lifted, and so we see some upside as a result of that. Additionally, with Intravision appealing to the Hispanic consumer market, and the fact that they're located in the southeast and southwest United States, they're due to benefit from upcoming midterm elections. And essentially their market footprint is in a number of swing state areas that possibly go either way. So it's expected that they can unusually benefit from strong advertisement and marketing to the Hispanic community this year, late in 2014. Additionally, let's see, we have the World Cup Soccer coming up, and it's going to be hosted in Brazil in 2014. And since Intravision's market is in the same time zone, they're going to be able to show a lot of live games. So the media and ad demand will be a lot stronger, and they can command a lot higher rates for showing the World Cup match in their markets. You know, as opposed to in 2010, it was the last World Cup. It was held in South Africa. So the World Cup was held in South Africa, so it's a significantly different time zone. So you can imagine that you wouldn't command the same type of ad rates for showing a delayed game or even a live game, when most people in the United States were asleep. It wasn't prime time here during those live games. That's another thing. So yeah, so with the FCC ruling, the upcoming midterm elections, and the World Cup Soccer, Intravision is expected to benefit nicely from those trends. Additionally, they just started paying a dividend in the fourth quarter of 2013. So there's a number of positive things going on with the company. Going on to the metrics page, once again, the annual revenues over the last 12 months was $224 million. The net income was $134 million, and the cash from operations was $33 million. The operating margins for Intravision were 33.7% in 2012 and 30.8% in 2013. Over the last few years, overall, the operating margins have been around the 30% range. The trailing PE ratio for Intravision right now is 20.7, and the forward PE ratio is 9.4. So you can imagine that reflects quite a bit of a strong expectation and an increase in earnings. So earnings are expected to increase quite a bit, and that's reflected in this differential between the PE ratios from 20.7 to 9.4. The PEG ratio is at 0.6. Less than 1. That usually implies it's a good value stock to consider. The price to sales ratio is at 2.1. The price to book is at 3.4, and the enterprise value to EBITDA is at 11.4. The recent closing price for IntraVision is $5.18. The 52-week low was $4.17, and the 52-week high was $7.36. The 20-day moving average is $5.60. The 50-day moving average is $6.20, and the 200-day moving average is $6.03. The average daily trading volume for IntraVision is 732,000 shares per day. The beta for the stock is 3.2. So this stock definitely has been quite volatile with respect to the market. It goes up a lot more when the market goes up, and it's gone down more when the market has gone down. The dividend yield, they just started paying a dividend in the fourth quarter of 2013. It stood at 1.9%. And since they just started paying a dividend, the average dividend payout ratio really is kind of meaningless at this point. On to the next slide, we're taking a look at the price chart for IntraVision. Overall, it just kind of shows a stock that started out the year right around a little more than $4, and right now it's a little more than $5. They've had a couple of peaks throughout the past 12 months where it's slightly surpassed $7 or approached $7, and the stock's just kind of oscillated in that range. But over the last 12 months, they have had a net increase of 21.56% over the last 12 months. And based on our findings and what's going on and the earnings expectations as mentioned, we think the stock can run up quite a bit more. Well, on to the next slide, the financial statement quality of IntraVision. That is one drawback. The financial statement quality is what we would classify as fair. Let's see. Over the next 5 years, the total amount of debt due they have is $91 million. And their annual, the profits, the net profit in 2012 was $14 million. In 2013, it's $22 million. In 2014, the net profit is expected to be somewhere around $50 million. So, that against a debt due over the next 5 years is $90 million. You can imagine that it is manageable, but it's not like there's a very, very fat cushion there. So that's one drawback we have with regard to this name. The operating margin trend overall, it's been flat. They are healthy in the 30% range. And the price pattern trend, it's been increasing. It's been up over 20% over the past 12 months, and it has been significantly higher at times. And as we mentioned, we think that there's been a pullback recently just because of the uncertainty around that FCC ruling, which is now being cleared up. The overall market right now has been bearish. We are starting to see a number of names pull back, but we expect this bearish trend to last only a few more months, especially since we're now seeing these corrections happening primarily in NASDAQ listed companies. So IntraVision may have some headwinds, and by the way, even though IntraVision is a much smaller company, they are listed on the New York Stock Exchange. They're not a NASDAQ company. So the recent closing price for IntraVision was $5.18, and we see its 12-month price target at $11.40. They've got a number of trends that are favorable to the company based on the markets that they operate in, and some uncertainties cleared up with the FCC ruling. So we see IntraVision having a 12-month upside potential of 120%. So consequently, we see IntraVision Corporation as the best TV broadcasting stock to buy right now. And on to our next slide. This is something a little different from, or I should say a lot different from our previous presentations and wrap-up sections. But one thing we're glad to inform you about is that our investment management business is now open and we're accepting clients. Connor Management Group is an SEC registered investment advisor. So, if you're looking to increase your savings, improve your lifestyle, accelerate your retirement, or just have a bit more financial cushion, then we think our investment management service is the solution. You've heard us talk about our proprietary algorithms, and using our proprietary algorithms, we invest and monitor our clients' funds in concentrated investment portfolios, and that's investment portfolios with a lot fewer names. And these funds will be invested in just 10 to 20 different stocks at a time, depending on the strategy you select with us. And by the way, in case you didn't know, the average mutual fund invests in 150 stocks, and that's just the average. Some of them invest in a lot more, so you can imagine why it's sometimes difficult for them to beat the market indices. Additionally, something else that's different about it is just that we use a separately managed account arrangement, and we're finding that that's very attractive to a lot of people. A lot of people have heard about a lot of these financial scandals that have gone on, and it gives them quite a bit of legitimately discomfort. What's special about the separately managed account arrangement is that you open up the account and you grant us discretionary authority to invest your money only. We cannot withdraw it or anything of the like. You're in control of that. And unlike a mutual fund, you can see exactly where your funds are invested 24/7. You remain in complete control. Now, we offer 4 different strategies, and these are all supported by our proprietary algorithms that review, rank, and analyze over 3,500 stocks every week. And we want you to know that for every holding, we identify a price target in advance, as well as a date for that stock, and over the next 6 to 12 months. So our 4 different strategies are created to satisfy different risk appetites. We have a dividend/equity income portfolio strategy for those that are just interested in dividend stocks. We have a value portfolio strategy, which is low turnover, deep value stocks that will be under pressure to appreciate over the next 6 to 12 months. We also have a long short portfolio strategy where we take long or short positions, minimizing the effects of a market, whether it's in a bull or a bear market. So we would take long or short positions. And additionally, we have a option portfolio strategy. And that is a high risk, high return strategy where we take call or put options on stocks that we identify as having a very strong potential to go up or very strong potential to go down. So those are 4 different strategies that we think will give our clients a lot more flexibility in finding above average return investments. So all of this is that we're taking advantage of the latest technologies and we're combining them with our own proprietary algorithms to bring you a new level of investment management service. We think you can reach your financial goals faster, and additionally, you remain informed and in control of your funds at the same time. So if it sounds of interest to you, you have $25,000 or more to invest, call us about opening up a separately managed account, and we can get started. We can be reached at 281-947-2201. That's 281-947-2201. Or you can just reach us on our website, and you do that by just visiting www.connormg.com. That's Connor, CONNERMG.com for Connor Management Group. So that's our new separately managed account business. I hope you check it out and consider being a client. And that's all we have for this week. Take care and talk to you soon.